I'm not saying you do not have to be a buy and hold investor. I'm just saying that you can be a better buy and hold investor. You can be an intelligent investor by incorporating options into your buy and hold process. And anyone out there telling you not to do this is a charlatan, and you should run from them as fast as you possibly can, because they don't understand how much money you're leaving on the table over the years. Like I said, potentially thousands, even millions of dollars by not using these four strategies if you're doing a buy and hold process. Right? You can do this in a Roth IRA, a traditional IRA. This is the kind of normal. Now, the wheel strategy stops here, where the safeguard strategies we teach that to Dorian Trader goes into two other strategies, and we're going to go over that in the next one here using Exxon Mobil. Once again, it's a dividend aristocrat. So if you're doing a covered call, you have in this video we're going to discuss how you can be an intelligent investor, how you can take buy and hold or the buy and hold process to a whole nother level to enhance your profits over time, how you can gain thousands, if not millions of dollars over a lifetime of investing by using what we believe is four strategies that will completely transform the buy and hold process to make you a true intelligent investor. We have so many academics out there that are preaching a buy and hold process. Just put your money in the index and let it sit and forget. And they're encouraging people by the millions to be basic, to be average. When the market goes down big, you lose big. When the market goes up big, you win big. You make the exact amount percentage-wise as everyone else that's doing that strategy. It's funny that that's the only time we encourage people to be average, is when it comes to investing. Just put your money in an index and forget about it. Be average, be happy with that. But they don't say that with anything else. They don't want you to be average in school. They don't want you to be an average doctor. They don't want you to be an average lawyer. No one wants to be average in anything, right? You're either one of the best or you are an afterthought. Why is it that they want you to be average in an investing world? In this video, we're going to show you how to stop being average, how to take that buy and hold process and make it even safer, but to lower your cost basis, to make it cheaper for everything you do over time, which will save you thousands, if not millions, depending on how long you're going to be investing. We're going to talk about what we call at the Dorian Trader the safeguard strategy. Many of you have heard of the wheel strategy. At the Dorian Trader, we take that wheel strategy and we enhance it by adding two additional strategies to it. And we'll talk about that in just a second. But for now, I want you to know that it's something better out there than buy and hold. It's something significantly better than buy and hold. And I want to grab your attention. I want you to sit down in your chair, get your pen and paper, or push pause on this video from time to time and type away some of the ideas that you get. Type away some of the things that it makes you think about. You want to be able to make a ton of money over a lifetime without the stress, or as little stress as possible. And we can show you these four different strategies we're going to talk about. But before we do that, I want to point out that we're really trying to grow our YouTube channel. We have less than 5,000 subscribers, and we've been putting out over 300 videos. And we believe, and if we're wrong, let us know in the comment area, that our videos are getting better and better, and the quality is, if not as high as others out there in our industry, is just as good. We are trying to provide a significant amount of value. So if you're watching this video and you haven't subscribed to us yet, please do help support us that way. We're not asking for any monetary type of amount. We're just asking you to hit subscribe. It's not going to cost you anything. Please support us that way. We'll super appreciate it. With that said, let's jump into these strategies that will enhance your buy and hold process. I'm not saying you do not have to be a buy and hold investor. I'm just saying that you can be a better buy and hold investor. You can be an intelligent investor by incorporating options into your buy and hold process. And anyone out there telling you not to do this is a charlatan, and you should run from them as fast as you possibly can, because they don't understand how much money you're leaving on the table over the years. Like I said, potentially thousands, even millions of dollars by not using these four strategies if you're doing a buy and hold process. Right? You can do this in a Roth IRA, a traditional IRA. This is the kind of normal retirement accounts. All right, so let's jump into it. So you know about the wheel strategy. When you're doing the wheel strategy, you are starting off by selling a naked put. So in this example here, we're going to go over a company called 3M. It's a dividend aristocrat. We're going to be showing you four different dividend aristocrats in this video. We believe doing this type of strategy on dividend aristocrats, or even doing it on ETFs, doing it on indexes like the SPY, which is the S&P 500, the QQQ, which is the NASDAQ 100, it's perfectly fine, and we encourage you to do that. But doing it on safe things that have been around and will be around. And so we're giving you 4 examples here of dividend aristocrats. Dividend aristocrats are companies that have been around for at least 25 years, have raised their dividend for at least 25 years, and they have paid that dividend for at least 25 years. Okay, so it's 3 different criteria that makes up a dividend aristocrat, and some of these things are dividend kings. Okay, some dividend kings out there. 3M is a dividend aristocrat. So if you're going to start off with a wheel strategy, what you normally do is sell a naked put. In this example, I'm going to sell a naked put at the 98 strike with 3M's trading about 98.33. The market is currently open while we're doing this video. And if you were going to do this, you would get about 226 at the mid price. And it would require you to put up in an IRA account. That's what we're basing this on. You have to put up $9,574 to be able to do that. And that would be your cost basis, which is about $2.26 or a little bit more than that than what it's currently trading at. So you would be getting this for a discount. If 3M dropped, you'd be getting it for less than what you would have to buy it for right now. So you're already saving yourself some money by starting off by selling a naked put. Okay. We talk about this in other videos, so we're not going to go over all the details about the naked put, just giving you the strategies here. So the first strategy, the wheel strategy, is selling a naked put. Then if the stock drops and you have to take ownership, then you do what is called a covered call. Right? And a covered call is when you sell a call against your 100 shares. So you have 100 shares and you're basically renting out your shares. You're using your shares as an asset. You're using your shares as if it was a house, and you're renting it out on a weekly or a monthly basis, even a yearly basis. You have to decide. In this example, we're using basically a month. So if you had 3M here, and let's actually do that. Let's actually do this one on a different stock here. Let's do it on Cardinal Health. This is also a dividend aristocrat. Okay, this is also a dividend aristocrat. All of these are going to be dividend aristocrats. So if we go over here and we look at this one, we go 31 days out and we do a covered call, you can see that you're going to be renting out your shares for a month, as we indicated, and someone's going to pay you, in this example, about $1.13 or $113 to be able to buy this call from you. And you're renting out your shares with giving someone the ability to rent to own. So if it goes above 88, then your shares will be taken away. If it doesn't go below 88, you get to keep all of that money. You get to keep all that money regardless, but it's hedging you. It's giving you more monies. As it goes up, you're collecting more. You're getting an additional dividend. All these stocks, as we indicated, pay a dividend. You get an additional dividend. So if you started off, what you can, if you're doing the safeguard strategies that we teach to the Dorian Trader, you can start off by selling a covered call. You can do it in the money. You can do it deep in the money. You can do it really far out of the money, something similar to this. But in this example, you're getting a cost basis about 84.55. It's currently trading at 85.64. So you're lowering the cost basis instantaneously by doing this covered call. So that's saving you, once again, thousands, potential millions of dollars over the years of lowering your cost base by collecting more dividends, by collecting more off the assets, off the shares that you own. So if you own 100 shares, you can do these type of strategies that we talked about. So this is the wheel strategy. Once again, if you want to get more details about the covered call part of the wheel strategy, then please check out some other videos. We go over it in great detail. Now, the wheel strategy stops here. Where the safeguard strategies we teach at the Dorian Trader goes into 2 other strategies, and we're going to go over that the next one here using ExxonMobil. Once again, it's a dividend aristocrat. So if you're doing a covered call, you have unlimited risk, or risk all the way to 0. If you're doing a covered call, you have less risk than the person just outright buying the shares, but you still have risk all the way to 0. So if you do a covered call and you take some of the monies, like in this example, you take about $152, $150, and you buy a put, then you can protect yourself to the downside. And at the Dorian Trader, we teach people to protect themselves maybe 5, 10, 15, 20% down. 10% is considered a correction in that stock. 20% is considered a bear market in that stock. So in this example, on ExxonMobil, we can use up to $150, let's say, give or take, and we can buy, in this example, we can go in here and we can decide we're going to buy this 102 strike here. So what would happen here when you do a collar strategy is that if ExxonMobil drops a significant amount in the next 31 days, you will stop losing at 102. Your risk stops at 102. So if you did this collar strategy every month, you can decide where your risk stops every time you do this type of strategy. This is a bullish strategy that has a really tight stop loss order that you can stop losing at that point. And this is the case here at the 102. I'm not going to go once again over this in great detail. You can check out some other videos on it, but the collar strategy allows you to reduce the amount you can lose if something is falling a lot. So if you go back to the bear market of 2022, this strategy would have helped you significantly to the downside as you lowered your cost basis every time you did it, but you wouldn't have had the big drop that some of these stocks experienced. All right, so then the last strategy, let's go over here and let's look at Walmart. and you can have a last strategy. And the last strategy is what we call the Bionic Bull at the Dorian Trader. It's a way to be able to have unlimited upside with a buy and hold type of strategy. So obviously, if you buy the shares, you have unlimited upside, but you do have some risk to the downside. You do have risk all the way to zero. But in the wheel strategy, you can never have unlimited upside potential. But at the Dorian Trader, we teach the safeguard strategy, which gives you unlimited upside if you do what we call the Bionic Bull. So let's look at this, and we're going to look at it with 31 days because that's what we've been doing. We're looking at Walmart. Once again, Walmart is a dividend aristocrat. So if we sell this put, and instead of just doing a naked put, if we take some of those monies and we buy a call, then we can have theoretically unlimited upside. So if we bought this 160, we'll still have unlimited upside. And our call spaces would be 154, just under 150, 155, right? 154. 70. That would be our call spaces. It's currently trading at 156.66, so darn near $2 lower. That would be your call spaces, but you have unlimited upside, as this TastyTrade platform is indicating. This means they cannot define your upside potential, and so this is buying the shares, basically having unlimited upside for a discount. You get in it for lower than what you would have to buy the shares for right now, which is 156.66. So keep that in mind. At the Dorian Trader, we teach you how to have unlimited upside potential and still lower your cost basis. Every time you get into a stock that has options attached to it, you can always get it for a discount, and you can make your trading of that or your investing in that company safer by using these 4 different strategies. If you want to learn more, please check out some of our videos. We thank you for watching. Please subscribe to our channel. Help us out. We would super appreciate it. See you in the next video.